Patrick Code. And my guest today is Tom Anderson. Tom is a CPA, not a CPI, a CPA and a senior advisor with the Ferguson Alliance. And he provides financial and management advisory services to family owned business owners and their senior management team. So I'm going to bet, because Tom is a CPA, we're going to talk about finance today and how that can positively impact your cash flow. So let's bring Tom on the show. Hey, Tom, how are you today?
Well, good morning, Josh. I'm glad to be with you. I look forward to our discussion today.
So tell me something. I am really, I would love to see this happen more often, but how do you do simple business financial reporting for the non financial business owner?
Well, actually, this is something that's near and dear to my heart because after spending years and years of working with clients, some larger, some smaller, I learned that quite a few are very skilled at their businesses, but they really don't understand the nuances of the traditional financial reporting. So, in my opinion, it's very important to create something that is focused, simple, and consistently reported so that the trends that are occurring in the business become more discernible for the layman, if you will, a non financial executive.
Well, how would you help them find what the trends are and then interpret that information?
Well, there are many things that are suggested by finance professionals. KPIs you hear about, key performance indicators, quite a lot. What I've found in my experience is that so many non-financial owners who have great sales or operational talents and so forth, really they see the numbers, they understand that the number greater or smaller might mean something, but that's about the limit of most of their true comprehension. So I've focused in collaboration with another finance professional on five what I call foundational or fundamental aspects that seem to be holding true for every business. So first of all, there's a foundational cash flow concept that I believe in that over time, a trend again shows whether the business is producing meaningful cash flow, and it does so in a more simplistic way than the traditional GAAP, cash flow statement. And then
So
the
what would that
other,
what would that look like, Tom?
basically an adjusted version of operating earnings plus the non-current asset changes. A lot of owners make choices to invest in plant and equipment or other types of non-current financial investments, and those can significantly affect the cash flow and other elements of the business, such as liquidity and borrowing capacity and other elements that are really critical to know if the business is becoming more healthy or less so.
So what's number two?
The operating earnings that I mentioned beyond the foundational cash flow, I always think it's important just to look at an adjusted operating earnings without the non-cash expenses and see if it's really generating true earnings. And then also sales. So if sales are trending up or down, there's certainly drivers behind that, and that's an important area of focus. So that's really number two, those two combined. The other three, four, and five relate to liquidity and also value of the business based on a consistent uh, EBITDA or other metric multiple. And then finally, borrowing capacity. Is the business in a good position, should it want to or need to make a term debt investment with the help of a financial resource or not? And how much is that? So that a business leader is always prepared to be able to act with confidence that the business can carry a certain amount of new debt financing.
So I want to challenge you a little bit on this because I've been doing this for a long time with business owners myself,
Of
and
course.
I'm not a CPA, but I am, I own my own food service business and have a very deep operational history. And my challenge is that when I talk to folks like you, and most of the numbers you come up with are historical. And in my experience, historical's nice. You need to look at them, but they're not especially predictive about what's going to happen in the future with the business. So when I develop a dashboard, which is what essentially I would recommend, absolutely we want to know what receivables and payables are. If they're growing, that could be a problem. If they're shrinking, it could be a problem. But it's not especially predictive. It sort of says, okay, here's what's going on. I would rather know. I say, okay, what's my backlog? That's predictive. If my backlog is growing, it could mean I have an operational problem coming up. If my backlog is shrinking, I can almost guarantee I'm going to have a cash flow problem because of that. And if I do this over a 13-week rolling basis, which is what I recommend for folks, I see a trend. And you're absolutely right. Trend management is key. Um, the other thing I think is that, and I think you're absolutely right, business owners really don't understand cash flow. And the reason is they understand the profit and loss statement. And what I would love to see people do is take the profit and loss statement and create a basis for them to look at it based on cash flow. Because, the truth is profit, if without profit, eventually you run out of cash, no question. But for example, with my food service company, we had borrowed um, about $1.5 million to buy vending machines. And we were supposed to pay that back over a 5 year period. Unfortunately, my depreciation was done on 8 year depreciation. So the depreciation didn't cover the principal and interest payments that we were required to for the bank. And we ended up running out of money because I didn't understand that principal payments never show up on a P&L. And I
Exactly.
thought depreciation was actually a real thing. It's, a fictional thing. So it seems to me that I don't care how much you hate the numbers in your business. If you're going to be a business owner, you need to learn to speak the language of business.
Very
And
true.
the language of business is finance, whether you like it or not. Now, you don't have to understand the top part of a cash flow statement because it's mostly backwards. Something that creates cash will show up as a negative, and something that uses cash shows up as a positive. And business owners never can figure that out. I don't care what you do. But if I do go down and I just show them the gee, did we borrow more money than we made? Did we make more payments than our cash came in? And those are pretty easily, those numbers you can actually discern on a cash flow statement relatively easily. And they don't look backwards like the rest of the statement does. Does that make sense to you?
Well, it does, and I agree completely. I think that two things. One is narrowing the number of concepts that someone's trying to track and follow, combining it with a forecast or a projection is critical. I, I like to present these five fundamentals in a stoplight fashion, red, yellow, green. So someone sees if their trend is running in a positive way, a negative way, or neutral, or just a cautionary yellow. And in that sense, it brings the focus to those areas that might need further questioning and deliberation. So if you see a red one, obviously the conversation with the owner, who typically will only give you 15 or 30 minutes anyway to understand what's going on before their eyes begin to glaze over. If they're speaking to an accountant or a financial person, a lot of times this isn't their favorite subject. So the idea is to get to the point that's important, talk about what the drivers are that you mentioned. And a lot of times it's decisions that they've made that they view as being positive for the business, but they don't understand some of the financial ramifications well enough. So bringing that conversation to a good focus and combining it, as you say, okay, if we keep doing what we're doing, when are we going to run out of cash? Or when are we going to see an increase in the value of the company? after all, I mean, the whole game is to make a more valuable company at the end of the day. And if
Well, you
you're
know
making
something,
this,
for
go
for
ahead.
some for some business owners that's true. But about 50, 60% of the businesses that ever go for sale never end up selling. And
True.
about 80% of the businesses are never sold. They just get, you've got that 50%, and the other 30%, they don't even go for sale because they're not sellable at all, and the owners know that. So the real key here, at least in my experience, is um, to get the business owner to understand that their business is an asset, but it's not the only asset. And if they don't pre-fund their financial independence, they're likely never to reach that. Does that make sense?
Well, it does. And what we find in our practice, which is primarily or only focused on family businesses and of the nature of much of what you're describing, is that at least 80% of the individual's net worth is tied up in their business. And they spend a lot of time focusing on that 20%. And they might even have advisors and people who are helping them with the investment, but they don't spend enough time understanding the financial fundamentals around that 80%. So you're exactly right. I think also that we've learned that many of our clients have a life event or something changes. They may have an intent of never selling the business, or they may have an intent of their daughter or son becoming involved in the business, but in time it doesn't happen, or they don't have the aptitude, or they decide to become a doctor or whatever. But the point is, having a plan that is based on value improving and having something that is marketable, I think is still very important, even if they don't intend to sell.
Yeah, we call that having your company be sale ready. And, sale ready does not mean you're going to sell your company. It just means your
Exactly.
company's in a position that somebody else would want to buy it. Now, the other
True.
side of this, Tom, you just said, which is a really important thing, and it's something we spend a lot of time busting this myth around, is that if 80% of your net worth is your business, you basically do not have a financially stable life. And the reason for that is, let's just pretend you have a business that's making a $500,000 a year and you spend $250,000 a year. And let's say that's the free cash flow just for fun. And I go to sell that. That's what's called EBITDA, earnings before interest, taxes, depreciation, and amortization. The average sale for that will be somewhere between $1.5 million and $3 million. Let's just pretend it's a $3 million sale. And that $3 million gets sold. Now, after the business owner sells it, he's going to lose at least 10% of that to professional fees, people like you and lawyers, and maybe even people like me who help them guide through the process. Then they're going to pay approximately 30 to 40% in taxes. Let's just say 40% because I can do the arithmetic. That means they're going to be left with $1.5 million after a $3 million sale. And that's actually a pretty nice sale number. But if they wanted to go and invest that and then spend the money to live on, in the financial planning world, we say we have a 4% rule, which may or may not be accurate, but we'll pretend it is. That gives you $60,000 a year. Now, if that $60,000 is 80% of what you have to retire on, you're not retiring. So that's the reason we actually have a tool we show called the Four Boxes Financial Independence, which proves to business owners diversification isn't for safety, it's for independence. And the truth is most business owners who are the size that I work with and probably the size you work with, while they're running their business, they have a fair amount of excess cash. Most of these businesses have less than 25 employees. That means they can use retirement plans that will put as much money as they can possibly imagine away every year, up to about $250,000 if you're over 50 years old. So that's why I talk about when I say pre-fund your retirement. You've got a bucket that's your business, you got a bucket that's your retirement plan. You've got a bucket that hopefully is investment real estate that you run your business from, and then you have the other investment thing. So now we're going to get that balance down to business worth 40%. Now we're talking about a safety zone. Does that make sense to you?
Well, it does, Josh. And actually, within our firm, we have a question that we often ask our clients. Do you own the business or does the business own you? Because at the end of the day, if you can't afford to walk away or sell, if you want to put it that way, or even hand the business to junior, then or if you've created a situation where the whole business depends on you every day because you haven't created a management team that's able to run the business, if you're not literally looking over their shoulder, then the business owns you and you've not created that independence that you're talking about. And I couldn't agree with you more. It's a revelation that a lot of business owners never take time to recognize.
So when we talk about sell ready with our business owner clients, or our clients, period, so all of them own businesses, um, we say there's two things that are going to keep you from creating a sell ready company. One is you don't have a recurring revenue stream, which is true for like every construction company in the world. So we teach them how to build a sales process that looks like a recurring revenue stream. And the second is you don't know how to delegate. That's why you have a company with 15 people and not a company with 75 people. So we help them learn how to, in my opinion, learning how to delegate is the very hardest skill a business owner ever has to learn.
Very true. And it only becomes more complicated when it's a family member because you're so used to uh, raising your children or your family next generation in a way that they basically hear what you say and do what you say. And uh, in the business context, a lot of times, particularly generational, there's a whole different attitude will be. And so those communications really begin to break down. And often, not only is it an experience that most business owners only have once in their lifetime, they also find that they don't really know how to have that communication in a successful way. So it is complicated, and in the end, it's in their well-being to figure it out.
Family business is a whole thing altogether. I mean, it's like one of the challenges of family business is that Junior has been listening to their parents for their entire life. And there's a
Right.
family dynamic of how they communicate. Now, if Junior was working for anybody besides a parent, Junior's reaction to what their boss says would be completely different than what the parent says.
Exactly.
So, one of the things we like to see if the business is big enough is to make sure Junior does not report to a parent. Junior works for somebody else in the company, and we call this the leapfrog method of management. Typically, it's the chief operating officer, whoever that might be. Hopefully, it's not a family member.
Hmm.
Assuming it's not a family member, Junior works for the chief operating officer. And at some point, Junior will become the chief operating officer's boss. So you need to make sure that the COO has a compensation structure and a retirement structure that if Junior becomes their boss and it becomes untenable, they're made whole. But it's a pretty useful way to get Junior to be ready to take over the business.
No, Josh, I completely agree. And for those businesses that might not have that COO, Chief Operating Officer role, sometimes there's a company relationship with another company that can be that graduate school learning experience for that next generation. And they go there for a few years before they come back to the family business. And in that case, a lot of that learning can occur in that manner, even if the business otherwise doesn't have the management team to create that division. But
Or
it is
even if it
very,
does,
very important.
yeah, even if it does, you see that in the car business all the time.
Uh,
All the car dealers have what's called a 20 group, which is there's 20 dealerships that get together. And
mhm.
often you'll find that the dealerships will swap kids into each other's company for a period of years,
Yeah.
knowing full well they're going to go back to the family business at some point. but
Sure.
it's a really good methodology for trading and training the next generation. The other thing that's really good, they see a different business, a different operating methodology, and they're likely to bring back different ideas to the business that's just going to benefit it.
Yes, there should be a mutual benefit about that whole experience, and I couldn't agree with you more. It's very critical, and because of all this, and you're making the point, it really requires thought and planning. You need literally years to make it all, to plan it and then execute it. And too often, business owners wait too long. And again, a life event or a change of something else outside the business, perhaps, uh, forces a choice that could have been made earlier and often unsuccessfully.
And there's another reason you want to start early is that the rising generation usually, not always, but usually will have an employee mentality while they're working for mom and dad. They need to have the time and the systems in place that change that employee mentality into an owner's mentality. And by the way, that's also true if you have key people who are going to buy your business. Both of them
Right.
have employee mentality, and they can't become the next generation owners until they develop a mentality of what an owner thinks like. And it's different.
Very true. And that transitional experience, again, is something that most people only have once in their whole life. So it's not a surprise that they're feeling rather intimidated by the whole experience, or they just don't even address it until far too late.
Well, Tom, you have just given some really good reasons why people need to have a coach or an advisor or a mentor or somebody who knows the process and has systems in place to make it worthwhile. So we're out of time, and I'm going to bet that some of our listeners today would love to have a conversation with you. So how would they go about doing that?
Well, thank you, Josh. I've enjoyed it, and I agree. I think family business is our passion and what we really focus on, and we deal with these experiences often. And I would enjoy having an exchange with anyone. Our website is fergusonalliance.com, ferguson-alliance.com, and also on LinkedIn. It's easy to find my LinkedIn address or Ferguson Alliances as well, and we would enjoy engaging with any of your listeners.
Cool. And I have something I'd like you to do. I've been asking you to do this now for, I don't know, I guess going on 9 years because that's how long we've been podcasting. Wherever you're listening to this podcast, please, please, please give us an honest rating and review. If you love us, you can give us 5 stars. If you hate us, you give us 1 star. Then you get to watch me cry. You might be amused, but I'll get over it and I'll do another episode that maybe you'll actually like. So at any rate, please go wherever you're listening to the podcast, give us an honest rating review. It's really important. People tell me they like the podcast. We've been doing it for a while, and those reviews help us get found. So this is Josh Patrick. We're with Tom Ferguson. You're at Cracking the Cash Flow Code. Thanks a lot for stopping by. I hope to see you back here really soon.